How can you make your money work for you? How do you make your dream of passive income a reality? When most people hear passive income, they think stocks, bonds, real estate, and commodities. You, like most people, probably don't mention dividends. Yes, dividends as a source of passive income. Welcome, financial enthusiasts, to another exciting episode of Fun Financial Insights. Today, we're diving into the fascinating world of dividend investing, exploring the ins and outs of how to live off dividends and build a reliable income stream. Whether you're a high school student taking your first steps into financial realm or a seasoned financial expert, this guide is made just for you. Let's kick off our journey by understanding the fundamentals of dividend investing. Dividend stocks have a unique appeal. They not only provide regular income through dividend payments, but also offer potential capital appreciation. Historical data shows that dividend stocks have outperformed the S&P 500 with lower volatility, making them an attractive option for investors, both investors starting out and those approaching retirement. Dividends are payments made by a company to its shareholders from its profits. When a company makes a profit, it can choose to distribute some of those profits to its shareholders in the form of dividends. This is a way for the company to share its success with the people who own it. And it can be a great way for investors to earn passive income. They can be paid out in different ways, such as in cash, additional shares of stock, or other forms of consideration. The amount of the dividend and how often it is paid out can vary depending on the company and its financial performance. Some companies pay dividends regularly, while others may only pay them out occasionally or not at all. To grasp the essence of living off dividends, let's break down how dividend stocks function. Imagine you invest in a company purchasing 100 shares at $10 each, and the company pays an annual dividend of 50 cents per share. In this scenario, your investment of $1,000 yields $50 in annual dividends, equating to a 5% dividend yield. What makes dividends powerful is their predictability. Companies strive to maintain consistent payouts, providing investors with a steady income stream. Now let's explore some well-known companies renowned for their consistent dividend payments. Procter & Gamble and Lowe's, both dividend kings, have increased dividends for over 50 consecutive years. Chevron, with a 35-plus year streak of dividend growth, exemplifies the resilience of certain dividend stocks. Dividend stocks span various industries, showcasing the versatility of this investment strategy. Before you buy any dividend stocks, it's important to know how to evaluate them. These metrics can help you understand how much in dividends to expect, how reliable a dividend might be, and most importantly, how to identify red flags. Dividend yield. This is the annualized dividend represented as a percentage of the stock price. For instance, if a company pays $1 in annualized dividends and the stock costs $20 per share, then the dividend yield would be 5%. Yield is useful as a valuation metric when you compare a stock's current yield to its historical levels. A higher dividend yield is better, all other things being equal, but a company's ability to maintain the dividend payout and ideally increase it matters even more. An abnormally high dividend yield could be a red flag. Dividend payout ratio. This is the dividend as a percentage of a company's earnings. If a company earns $1 per share in net income and pays a 50-cent per share dividend, then the company payout ratio is 50%. In general terms, the lower the payout ratio, the more sustainable a dividend. Cash dividend payout ratio. This is the dividend as a percentage of a company's operating cash flow minimum capital expenditure, or free cash flow. This metric is relevant because GAAP net income is not a cash measure, and various non-cash expenses can cause a company's earnings and its free cash flow to vary significantly from one period to the next. This variability can render a company's payout ratio misleading at times. Investors can use the cash dividend payout ratio along with the simple payout ratio to better understand a dividend's sustainability. Total return. This is the increase in stock price, known as capital gains, plus dividends paid. For example, if you pay $10 for a stock that increases in value by $1 and pays a 50-cent dividend, then that $1.50 you've gained is equivalent to a 15% total return. Earnings per share. The EPS metric standardizes a company's earnings to the per share value. The best dividend stocks are companies that have shown the ability to regularly increase earnings per share over time and thus raise their dividend. A history of earnings growth is often evidence of durable competitive advantages. PE ratio. The price to earnings ratio is calculated by dividing a company's share price by its earnings per share. The PE ratio is a metric that can be used along with dividend yield to determine if the dividend stock is fairly valued. Now, understanding how dividends are taxed is crucial for effective dividend investing. Most dividend stocks pay qualified dividends, taxed at a favorable rate of 0 to 20%, depending on your tax bracket. However, some dividends are qualified as ordinary and taxed at your marginal tax rate. Consideration of tax-efficient investment strategies and utilizing tax advantage accounts enhances the overall effectiveness of dividend income. If you're finding this episode on how to live off dividends valuable and you're eager for more strategies to improve your passive income, hit that subscribe button now. Join the community of fun financial insights and let's continue this thrilling journey to financial mastery together. Don't miss out on future episodes packed with valuable financial wisdom. We appreciate your support and thank you for being a part of Fun Financial Insights. Now that we've laid the groundwork, let's delve into practical strategies for building a dividend portfolio. Opinions on portfolio size, diversification, and target companies vary, but certain guidelines can serve as a blueprint, holding between 20 and 60 stocks, equal weighing positions, limiting sector exposure to 25%, and targeting companies with safe dividends are key principles. Building a dividend portfolio is not a set-it-and-forget-it endeavor. Regular monitoring, adjusting position sizes, and staying informed about changes in individual stocks and market trends are essential. Tools like dividend safety scores can aid in assessing a company's dividend sustainability, providing investors with real-time information to make informed decisions. Whether you're just starting out or a seasoned investor, the power of dividends can be harnessed to create a reliable financial future. If you found this guide valuable, don't forget to like, share, and subscribe. Join the community of Fun Financial Insights for more exciting journeys into the world of finance. Stay tuned for our next episode where we unravel more secrets and strategies for financial success. Until then, keep exploring, keep learning, and remember, your financial goals are within reach. Subscribe now for more financial adventures with Fun Financial Insights.